Ladies and gentlemen, good day and welcome to Sundram Fasteners earnings call hosted by Avendus Spark. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ramakrishnan from Avendus Spark. Thank you, and over to you, sir.
Hey, thank you, Aman. Good morning, everyone. Ramakrishnan this side. I really appreciate everyone logging in. Very pleased to be hosting Mr. Dilip Kumar, CFO of Sundram Fasteners, and Mr. R. Ganesh from the corporate finance team. We'll start with brief opening remarks from Mr. Dilip and then follow it up with Q&A. Sir, would you like to make your opening remarks now?
Yeah, sure. Good morning. I welcome all the analysts for to discuss the Q3 results of Sundram Fasteners. Just would like to make a couple of announcements. One is that during the course of the day, we'll be uploading our presentation for the benefit of investors in our website. And just in case, should any media personnel access this transcription of this meeting, I would request them to check with me prior to publication of any of these things in the newspapers or online editions. So with these announcements, I will set the context for our results. We've had good Q3 in terms of revenue performance, and where we have done revenues from operations of 1,226 crores for the third quarter as against 1,024 crores, registering growth of 19.8%. The domestic sales has come in at 813 crores compared to 658 crores, posting a growth of 23%. And even the aftermarket has grown well for us. The export segment has benefited from rupee depreciation. Overall, the EBITDA for the quarter has come in at 188 crores compared to 180 crores. The margins have been under pressure, which I will explain later. The profit before tax for the quarter was 142 crores against 138 crores. And net profit for the quarter was at 106 crores against 103 crores in the corresponding period. Now, moving on to the 9-month operations, YTD numbers, the revenue from operations was at 3,684 crores as against 3,026 crores, increase of 21.8%. The net profit for the 9 months was 348 crores compared to 336 crores. And before we discuss the consolidated financial performance, overall, just to give you a background, I think the inflation numbers, from economic perspective, inflation numbers have dropped below 6%. The interest rates may not go up significantly from here, though we expect US to have a soft landing in this year, 2023. And the budget has come out well with a huge outlay for capital expenditure, as we all know. Government has also maintained fiscal prudence. They have also relaxed or provided exemption up to 7 lakhs to increase consumption under the new tax regime. And they have also compressed the subsidies which form part of the revenue expenditure of the government. So this huge capital expenditure of 10 crore primarily going to railways and the highways, defense, all of this augur well for the company in general and automotive industry. The industry has done well in the 9-month period as well as this quarter, registering a significant growth in commercial vehicles, passenger vehicles, tractors, in which Sundram Fasteners is present across all these segments. The exchange for this quarter has been stable. As you know, Sundram Fasteners, 1/3 of revenues come from exports. That composition of that has not changed significantly, with almost 70% coming from OE business and aftermarket, and about 30% coming from exports. And the rupee has been stable this quarter compared to how it was in the first 2 quarters. The challenge which the company has faced is primarily the compression of margins, gross margin which you may have observed, is because of raw material price increase. Now, one is talking of softening of raw material prices. It may come as a bit of a surprise to some of you, but this has been in the air for quite some time, where the way the industry works is the OEMs and steel mills reach a settlement, and which are informed to the auto component players. Thereafter, we settle the prices with steel mills and back-to-back recover from our customers. It is largely this model works in the domestic industry, in the OE segment. But in the aftermarket, it's also recovered, because once it is sold to a distributor or a dealer or to a common man, thereafter you can't go back with any retrospective price increase. Therefore, companies tend to rise prices prospectively in the aftermarket. Of course, you have to take the competitor positioning in the market before you raise prices. We have raised prices in the aftermarket in November as well as December to compensate us for the raw material price increase. In the export segment, as we have explained before, there are various contracts. There are pass-through arrangements. There are arrangements where we share partially with the customer, and in contracts we don't get any compensation, or an indexation is linked to a different index which does not reflect the metal prices in India. There are various models operating, and even within the domestic OEM, we may not get compensation from all our OE customers, or it operates with a lag effect. And in the windmill space where we are present, you don't get compensation. So there are many nuances in all of this. So broadly, we recover in the year in which, or in the quarter in which the price increase is given, about 70 to 75%. And as the months roll by, we negotiate with other customers, and we aim to achieve 85 to 90%. So in this quarter, the price increase was given with effect from 1st April 2022 for a sum of 8,500 rupees per ton. From 1st July, it got reduced by 4,750. The combination of these two have occurred in Q3, because the settlement was reached only in Q3. So you are seeing the impact of that in Q3, and where there is a bit of an under-recovery from the customers. But I expect in Q4 that gap to narrow as we finish all negotiations and raise supplementary invoices and debit notes with our customers. So sequentially, if you see at the RM stage, we've been impacted by 1%. But I must say here that our variable costs have been fairly stable across different points of time. Be it the YTD number or for the quarter, or even preceding quarter, it has been stable. The company also has controlled fixed costs well, and it has been flat, with higher revenues as a percentage it has dropped. The compression which you have seen in the compared to the corresponding period has been offset to some extent by the stable variable costs or manufacturing expenses, even though in manufacturing expenses also we have experienced inflation. The fixed costs have been controlled, so overall the EBITDA has come in at 15.2% compared to 15.8%. And the company has controlled the interest costs well because we use leverage on our export performance to avail packing credit. And company has also declared a dividend of 117 crores, including a special dividend for the 60th year of incorporation. We have absorbed all of that, and borrowings have been stable, and debt equity ratio continues to be stable and attractive, well below 0.2%. The company has gone ahead with its capex program, and we have capitalized about 150 crores at the half-yearly mark, and another 75 crores is others under construction. So our capex program is proceeding as per our plan. The effective tax rate, the tax provisioning has been made. So overall, the PAT for the year has come out, for the quarter has come out 106 crores compared to 103 for the comparative quarter. For the 9-month period, we have finished at 348 crores compared to 336 crores. And the revenues for Q4, we have had a reasonably good start for this calendar year. January has been good. We expect these levels to sustain in February and March. And we expect that we did about 1,225 crores in Q3. We expect some uptick in our turnover for Q4, and also the recovery from customers towards RM prices. So overall, I think our EBITDA margins and PBT PAT, everything should resume in the upward direction. But if you ask me whether it will move to EBITDA will move to 17% or 17.2%, the answer I have is our analysis suggests that based on the inflation, if I break it down for across different points of time, the raw material costs, if I remove the inflation from the numbers, it's hovering around 38%. The under recovery has cost about 2%. The difference between, when I say under recovery, is the difference between the customer compensation and the price we pay to the steel mills. And what used to be 40% RM cost, today it's at 46%. And the remaining 5% is purely the effect of math, where I recover from the customers, it is there in the denominator, and what I pay to steel mills is there in the numerator. So until the raw prices soften and roll back, which we have already experienced from July, if things improve in this direction further, then our EBITDA will definitely go in the positive or the right direction. This is just to give you the background to our EBITDA. And as far as the consolidated results are concerned, the overall performance for the 3-month period is 1,400 crores compared to 1,200 crores. Consolidated net profit was at 118 compared to 110. The 9-month period performance was 4,214 crores compared to 3,562 crores, recording growth of 18%. The consolidated net profit for the 9-month period was at 372 crores compared to 354 crores. So there have been questions about whether we've got a price increase from customers. And so I've answered that, yes, in parts we have received, we expect this gap to get narrowed in Q4. We don't expect to give any further price increase in the coming quarter. There are market news saying there will be a further drop. Some people are saying they might go up. But as of now, there are no pressures to give any kind of price increase for Q4. So I would expect the gross margin to sustain at these levels or only improve based on further recovery. The share of non-auto in our business continues to be around 1/3, no big change. And EV revenues continue to be around 3%. But we expect a significant improvement from 2024 onwards. You may have noticed that we had recently given a press release about the huge order which we had won. On 17 January, we had given a press release about a 250 million order for a OEM. And the production is expected to start in 2024 next year and peaking in 2026. It is a 6-year program where we'll be developing parts, assemblies for sedans and SUVs. And we are quite excited about that. So that is the story of EV, and as we bring more and more EV products into our portfolio, and this will definitely give us the impetus, and we hope to receive more RFQs from the same customer and from other customers for these kind of products, where it involves these products are intricate, involves complex engineering, and where we believe we have the expertise which we have built over a period of time. And our subsidiaries, the domestic subsidiaries, Upasana, performance has been stable. We have experienced raw material price pressures, and our IT subsidiary has also acquitted itself well. And the overseas subsidiaries, Cramlington Precision Forge, performance has been impressive for the quarter. It has reported profits, and the truck market is very strong in Europe. And the waiting period, as we understand, order backlog is 8 months. We have got compensation for customers for price increases. Overall, the operational capability of our UK subsidiary has improved. And given the strong volumes, stable output, and reasonable control over employee costs, the UK subsidiary has reported profit, and we expect the subsidiary to make profits for the entire year as well. And moving on to China, China has experienced various pressures, as most of you would know. Typically, in the Q2, they had this COVID situation. Shanghai was shut down for about a month. We are located pretty close to Shanghai. In Q3, they had the heat wave. In Q4, they relaxed the COVID controls, and people also were allowed to travel freely, and many of them were reunited with their families after a couple of years. And we understand the labor shortage is there because people have not come back. And while customers have been demanding, raw material prices have gone up. Unlike the Indian context, where you get 100% compensation with OE, the situation is not the same. The China is a very different market. But then we are also reasonably insulated because we are not dependent only on the auto market. We also have non-auto business there, 50-50. It's split 50% equally. So China has experienced challenges, but Cramlington has done well. The domestic subsidiaries have been stable. and we expect this to continue in our Q4 also. So, with these, comments where the economy is doing well, the industry has done well, the budget has come good, and our quarterly performance has been reasonable despite the market conditions, uncertainties, especially in the Western markets. And we expect a stable Q4. So with these comments, now I would request the audience, if there are any specific questions, we are happy to take them on.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may please press star and 1. The first question is from the line of Ramakrishnan from Avendus Spark. Please go ahead.
Hi, I'll go first while the question queue assembles. I'll let the other participants ask follow-up questions, especially on EVs. My question, sir, is on exports. So how are you looking at demand trends in the export market and talking about the standalone operations here? Last time you talked about demand in passenger cars being a little soft while truck demand was robust. How are you seeing that pan out? And in USD terms, what revenue targets do you have in mind for exports?
Yeah, so we expect to close the year somewhere between $180 million to $200 million. So that is what I think we would do, because despite the slowdown and improving schedules in Q4, based on indications from our leading customers, in dollar terms, we will probably be close to $200 million. That's about 1,600 to 1,700 crores per annum.
Okay. Okay, excellent. Thanks for that.
Thank you. The next question is from the line of Vimal Gohil from Alchemy Capital. Please go ahead.
Yes, my first question is a follow-up to Ram's question. You mentioned that the truck market, especially in Europe, is doing well.
Just a second, operator, can you increase the volume because it's not clear to us?
Yes, sir, yes. Done that, sir.
Yeah. Am I audible?
Yeah, better.
Great. So you mentioned that the truck market in Europe is doing well. Just wanted to make sense of this, given the backdrop that we are seeing in Europe on macros. Despite that, typically that you would expect the truck markets to be under pressure. But what is this driven by? Is my first question. The second question is on your recently announced EV order. Now, if you could mention which is the OEM that we've got this order from, and you had also given the guidance that we'll be touching about 2,000 crore of revenue in EVs in 4 or 5 years, whereas this order mentions about 6 years of peak revenue. And where is the disparity in between? And also, what would be the mix over here, PV versus CVs?
Yeah. So the first question on the European front, while the semiconductor shortage, may have had a bearing to some extent on the vehicle demand. The driver, as I had explained even in our Q2 call, was the e-commerce. Post pandemic, during the pandemic, people had got into the habit of buying online, and the percentage of revenues which all companies now are deriving from online procurement has gone up significantly. So therefore the trucks are in great demand post pandemic because of the online connectivity. The last mile delivery which is now required. So the shopping malls and others and e-commerce operators have come to the center stage, which is driving the demand. And like I said, the order backlog is 8 months currently, and also the replacement, not only the demand has gone up for trucks, and also the replacement demand, and both have helped to position our UK subsidiary well. Now coming to this, our EV business, what we have said is that we would do about 2,110 crores over a 5-year period, and this is part of that is $250 million. So it was not a revenue target for a year, which we said we will achieve 2,110 crores over a 5-year period. And this will help to move us from the current level of 3% EV, maybe take us to 5 or 6%. And eventually, as an intermediate target, we would want to go to about 10% of the revenues and take it ideally to about 15% of the revenues. So we have taken the first steps towards that, and this is a big win for us. And this is just the right direction.
Right, sir. And the 200 crore capex that you have announced in this particular project, would this be fungible? That is point number one. And also, if you could help us, that will you be able to sort of replicate this for other customers in Western geographies as well as even domestic? So, what are your plans for your electric vehicle platforms or products for the domestic business?
So, as far as the domestic business is concerned, we are working with all leading players, be it Tata or M&M. As and when Maruti is ready to come out, I think Maruti is focused more on hybrid vehicles at this point of time. So we have a strong customer connect, and we are familiar with all of them, with their programs and designs. So we are working with them. As far as this capital expenditure of 200 crores will be fungible across different platforms or customers, and therefore this business win with the OE should also open the doors for other products or increase in volume with this OE itself for the same product, and also help us with other customers. So this the order will definitely help us to get more RFQs from this customer itself and from our customers also. So therefore, we are excited about this, the breakthrough we have made in the EV.
Sir, if I may, one more question, please, on EVs itself. Sir, what are the return ratios like? If at all, if the assumption is that the return ratios or the IRRs, as you may call it, may be similar to our existing business, what will this be driven by? Are your margins or capital or your fixed asset turns any different, or how is the structure here? Is it any different from our existing business?
Yeah, we expect both margins and the ROC by about better than our domestic or current level of operations. For instance, if we are doing an EBITDA for 15-16%, this business will probably give us about 20-21%, and also ROC will also be significantly high. Currently, on all company basis, because Sundram Fasteners has got different products, so we have assembly operations, we have traditional forging, we have powder metallurgy. Well, these are not comparable in terms of returns, but in the EV business, we expect the returns from ROC perspective, also to be closer to 35%.
Wow. Okay. So, sir, the OEs are comfortable looking at, I mean, they are obviously looking at your profitability and then probably giving you the pricing. But OEs are absolutely comfortable with this, right?
Absolutely comfortable.
Great to hear that, sir. Thank you so much.
Like you say, based on company's performance or a particular division's performance, if as and when it happens, there may be some pressures may happen. But that is something we are used to, because this is not anything new, because there are many models which are operating where they promise you volumes, they want year-on-year price discount. So many models are operating. I'm not saying it operates in this case, but we are used to all of this.
Understood, sir. Thank you so much, sir, and all the very best.
Thank you so much.
Thank you. The next question is from the line of Sahil Sanghvi from Monarch Network Capital. Please go ahead.
Yeah, good morning, sir. Congratulations for a stable set of numbers, and thanks for this opportunity. My first question is regarding the same new order that we've got of $250 million. Sir, can you just clarify which components are these?
Okay. Can you be a little more clearer? I couldn't get the question.
Yeah, not clear to me. Can you come closer to the...
Is it better now, sir?
Yeah, better.
Right, sir. So, sir, I was just saying regarding this new $250 million EV order that we've got, can you clarify which component is this exactly?
These are different types of shafts.
Okay. These are
sub-assemblies and shaft sub-assemblies, which will go into mild hybrid, plug-in hybrid, and battery electric vehicles. Our current understanding is that 70% of it would go into pure EV, and another 30% would go into the hybrid, which is in SUVs and sedans.
Right, sir. And sir, when you were answering the question for the last participant, you did give the return ratio number, but did you also tend towards margin being upwards of 20%, around 20%? Am I right on that front?
Can you repeat that question? 30%?
Yeah, I mean, when you answered the question for the last participant, you did give a ROC number which is around 20 to 25%, but on the margin front, I missed the number. Can you give some idea on that?
So the ROC, just give me a second. Yeah, what I was saying is that we expect our EBITDA to be around 20% in this business, and our ROC to be around 25%.
Okay. And sorry, margins would be, sir? Margins you said 20%, right?
Around 20%.
Okay, got it, sir. Thank you. Sir, my other two questions are regarding one that when I look at some of these Class 8 truck sales and order numbers, because that forms 1/3 of our exposure in the export side, and again North America also forms a large chunk of our exposure. There has been a decline in the Class 8 truck orders, 25% month on month in January. And the peak has well been gone in September now. So overall, from Class 8 trucks and from the CV side in North America, are you seeing any kind of decline in the demand, moderation on that front? Any threat to our export revenues? If you can comment on that, please.
No, we are not experiencing any slowdown. It has been stable in Q2 and Q3. If at all, we expect a slight uptick in Q4, because as you know, it's a new calendar year for the Western markets. The customer indication has been advice has been for us to prepare for a growth only. They have not said the schedules will come down or it will be stable. So we are preparing for about 5% increase in revenues in constant currency terms in Q4.
Okay. That is good to hear, sir. Thank you. And my last question is regarding in one of the con calls, 1 or 2 quarters back, you had alluded towards a new powertrain component being designed for force, and you were expected to start commercial production in second half of FY23. Any developments on that front, sir? And what kind of revenue
potential? I saw it in an email also.
Yes.
Maybe we can discuss separately, but I don't, maybe there's some mix-up of facts. Because we are not developing anything for Ford.
Okay, so is that, I'm sorry, is that for Mahindra, sir? I mean, because you've alluded to this in the con call, so are we doing anything on that front?
No.
Okay, fine. Thank you, sir. I'll get back in the queue. Thank you, sir. All the best. Yeah.
Thank you. The next question is from the line of Karan Kokane from Ambit Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity.
Karan, request you to please use the handset.
Yeah, hi. Is it better now?
Yes.
Yeah.
Hi sir. So first question is on this USD 250 million order. So initially, in earlier calls you highlighted that you would be doing a capex of 350 crores for EVs over next 3 years. So this capex of 200 crores that you have stated, is this a part of that 350 crores or is this over and above that?
Yes, sir. It is part of that.
Okay, sir. And sir, second question is on the wind energy orders. So we are looking to add, new customers in Europe. So how's that been going?
Yeah, that is on course, and we started building or expanding the factory, and we expect the revenues to jump up from, let us say, from October of this year. So the project will realize its full potential in the 12-month cycle from October to September. So we are on course for that.
Okay.
We are also talking further with the same customer for next stage of expansion, but at this point of time, we have orders and expansion is on course, and the elevated volumes will start from October 23.
Okay. And sir, if you could just remind us, what is the revenue potential from this order and the capex?
So we are incurring about 80 crores of capital expenditure, and at the peak, it should reach about 150 to 160 crores.
Okay. And sir, in our result note, we've highlighted that, we've taken impairment for an investment in a subsidiary at the standalone level. So what is that regarding?
In our press release?
Yeah.
Very good. Are you sure? I don't think we talked about any. No, sir, we have not talked about any impairment.
Okay. I'll check that again. And sir, just last question on this, China.
You can write to me.
Yeah, I'll check that. Just last question on China. So you said that China is still weak. Other OEMs have talked about good sales in January, and opening up of retails and production also coming back. So how is the demand in January in China?
January has been okay. It is still not back to the high volumes or levels we would be comfortable with, but Q1 looks promising, but definitely better than December.
Okay. Yeah, thanks, sir. Thanks and all the best.
Thank you. The next question is on the line of Nitiksha Shah from Anvil Share and Stock Broking. Please go ahead. Nitiksha Shah, your line is unmuted. Please unmute yourself and proceed with the question.
Am I audible?
It's very faint. Can I request?
Hello?
Yes, you're audible now.
Yeah. Sir, I just had one question. When you said that non-auto comprises 1/3 of your revenue, so what all do we include in non-auto, sir?
Okay, I think for our non-auto, we include tractors which form part of the farm equipment, and also we have serving towards the wind energy fasteners. We are into aerospace fasteners, and we also supply fasteners for a wide application in the industrial segment.
Okay.
So these are all the broad categories which we include in the non-auto segment.
Okay. So, sir, how much would this tractors constitute? Because I think they would be the major component of the 1/3 that you are alluding to, right?
No, for us, the tractors would be in the range of 10 to 12%. Predominant business comes from our aftermarket, which go into varied industrial applications.
Okay.
Starting from steel mills to cement, food processing industry. So that's a broad chunk of the non-auto business.
Okay. So this aftermarket doesn't include our auto aftermarket, right?
Yeah. Auto aftermarket is not included in this classification.
Okay. Yeah. Yeah. That was from my side. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Pranav from ITUS Capital. Please go ahead. Pranav, your line is unmuted. Please unmute yourself and proceed.
Good morning.
Pranav, there's a lot of echo from your line. May I request you to use the handset mode? It seems that we have lost the line for the current participant. We will move to the next question. That is from the line of Naveen Chandramohan from ITUS Capital. Please go ahead.
Hi, can you hear me now? Am I audible?
Yes.
Yeah.
Good morning, sir. Thanks for the time again. Sir, if you take a slightly longer term, I would say a 3 to 5 year view on China, you'd commented on the short-term headwinds that you would face on China. But if you just take a slightly longer term perspective, one of the markets that has grown aggressively in the passenger vehicle EV space globally is in China. And considering that you now are transitioning into an EV portfolio on a slightly more aggressive basis, how would you look at your product positioning into China from here going forward?
With respect to China, our presence in terms of the segment participation is almost 50-50. We are there in the construction segment, so that is going strong for us. And we also work on the passenger vehicle and the commercial vehicle. That also looks, in terms of next 3 to 5 years, we see a strong market for that, as they manufacture roughly about 25 million passenger car, and in terms of truck also it's about 3 to 4 million. So I would say our presence in the construction as well as passenger vehicle and commercial vehicle would augur well going forward, and we are also capacitated to meet the customer requirement.
The EV portfolio is yet to grow, and so we are working on that, our EV strategy in China, but we probably will have something more concrete to say in about a year's time from now. But right now, it is focus is more on our traditional products for the construction segment and in the auto, where we are equally present between the commercial vehicles and passenger vehicles.
Got it, sir. And just one follow-up question on that. Considering that the penetration on the EV side has been reasonably deep with respect to China versus rest of the world, and considering that most of the competitors are focused on that area, and based on what you just said, you're looking at it from, let's say, 1 year down the line in terms of product development there. Do you feel that this puts us at a disadvantage as we speak versus some of the competition that we face in China?
So what I said was, just to clarify, what I'm saying is that we will have probably more information to share with you 1 year down the line. But the efforts and the product developments have already begun. We are not going to be at a disadvantage or start behind our competitors. We will be always ahead with our competitors. So work is going on. But in terms of telling you something concrete progress, products, customers, etc., probably about 2 quarters from now or about a year. That is what I was trying to tell you.
Got it, sir. Thank you so much for this. I appreciate this.
Thank you. The next question is from the line of Roland from GMO. Please go ahead.
Yeah, hi team. Thank you for taking my question. First question would be, you also have medium to long-term aspirations of export contributing half of the, to the top line. Right now it's close to 1/3. Now, if I look at the performance for the last 2 quarters, the share of exports have been coming down. And after the Q2 call, you had alluded to the issues in passenger vehicle when it related to semiconductor, and those were temporary. So going forward, for you to increase the share of exports need to grow faster than the domestic sales. So why is it not the case, and going forward, will this change?
Well, see, the domestic market has been very strong, and both aftermarket and OE businesses have been very good. And as you know, because of the chip shortage and the high interest rates, for various reasons, volumes had moderated in Q2. So the capacity was available and it is fungible, and we have used it more for our aftermarket and the OE business. So the long-term trend of 1/3 or eventually moving to 50% of our revenues coming from export market. So that remains our goal and our objective. We will pursue that. And the EV business will help us in the direction not only to push the frontier, but also give us good hold in the EV business.
Fair, sir. But because this EV business revenues will start incurring slightly a year from now, if I'm not wrong, at least in the interim, now that maybe some of these, as you are saying that in terms of CVs, Europe demand from Europe is very strong. So can we see a higher growth coming from export going forward, at least in the near term as well?
Yeah, in the near term as well, you will see growth. Definitely compared to Q2 or Q3. Like I said, the earlier part of the call, our customers have only advised us to prepare for higher volumes, at least by about 5% in 2023 compared to 2020.
Sure, but that comment you made for CV, is it the same case in PV, passenger vehicle as well?
Please repeat your question because it
So I was,
was not
clear. Yeah, I was saying that you mentioned a 5% higher order book indication that your customers have given for 2023 for commercial vehicle. Is the case the same in passenger vehicle as well?
Yeah. I think in passenger vehicle also we are looking at similar indication. It could be either on the ICE or on the EV. So we are working on both. So we see a possibility of growth in that segment.
Sure. So my second question is on the margins. Now you have mentioned about the how the mechanism works, right? And you are guiding for a improvement in sequential margin in Q4 onwards or starting from Q4. But then you also meant that for us to reach back to those 16 to 18% kind of level, raw material prices have to come down further, right? Because it's like higher denominator, and on that, we will earn a lower margin in percentage terms. Maybe in per ton terms, it would be similar. But my question is that if everything else is equal, because we are, share of exports, which I assume would be higher margin, will increase. Don't you think that there would be a gradual improvement in margins because of the product mix and the geographical mix of the sales? Is that a fair assumption? For, let's say, in near to medium term as well?
Yeah, that is a fair assumption to make, sir. That's a fair assumption to make.
Okay. So, so our margin improvement trajectory is not entirely dependent on how the raw material prices would be, right? In a stable raw material prices regime, gradually there would be a sequential improvement of margins, right, because of these changes that I have mentioned.
Yeah, yes, your assessment is correct. Not 100% dependent on RM moving alone.
Agreed. Okay, sir. Okay. Last question would be this 200 crores of capex that you have announced for this new EV project. Obviously, part of that 300-400 crores that you had already specified. Does this come under PLI by any chance?
Yeah, correct. It's part of the PLI program.
Okay. And so when you are mentioning about 20% margins and 25% RO return ratios, you are expecting, you have calculated or you have included the PLI gains as well, right? Am I correct?
No, we have not taken this PLI into account in all our commercial decisions because, as you know, there are many catches to it. So our assumptions, our return expectations or margin expectations are not predicated on the PLI incentive.
So this is pure commercial, which means that in case if a lot of catches, we were to avoid that and get the benefit, the margins as well as return ratio could be higher than what we have guided for.
Absolutely.
Okay. Thanks a lot. I'll come back in the queue if I have more questions, but thank you for this.
Thank you.
Thank you. The next question is from the line of Mithili Balakrishnan from Alchemy Capital. Please go ahead.
Thank you for the opportunity. I had a couple of questions, which is starting with, could you help us a little bit with the mix in the OE segment? How much CV, how much PV, etc.?
With respect to the domestic business, the CV inclusive of engines would be in the range of 30%, and the passenger car would be in the range of 35 to 40%. And tractors, as I mentioned, it will be in the range of 10 to 15%. So this is the broad.
And what about wind energy?
Wind energy would be about 5% of the overall revenue.
Okay. Also wanted to check with you on the capex. On a consolidated basis, what's the kind of capex we are looking at for this year and the next, including this whole investment which is happening for the EV, etc.?
So the subsidies level, we are not incurring capital expenditure much. Apart from what we had committed, it's a planned where based on previous year indication, we are adding capacity, maybe some heat treatment furnace in China and some machining capacity in Upasana. But the bulk of the capex will be incurred at the standalone Sundram Fasteners. And in the last cycle, we had incurred about 1,000 crores before we took a pause because of the slowdown in 1920, thereafter 2 years of pandemic. That cycle has resumed, and we should incur in the next 3 years, that is FY23 to 25. If all our PLI programs come through, another 1,000 crores of capital expenditure.
Got it. And just to get a sense of the Sri City situation in terms of capacity utilization, what happened to that customer who was there, etc.?
With respect to Sri City, while we have been working with the customer on approval and validations, all those have come in place, and we have started billing directly to the customer, and the capacity utilization is moving upwards. And 23-24 should be a good year for Sri City plant.
Sorry, could you just help us out with the initial capex and is it expected to have similar fixed asset turns as the rest of the business?
Yeah, the capex, whatever we had indicated in Sri City was 100 crore plus, and I think the asset turn would be on similar levels of other Sundram Fasteners business.
Got it. And that full capacity ramp up will take till say 25 or later. The initial phase is only the
happening during FY24 itself.
Okay, full ramp up. To the full extent, sir?
Ramp up. I said ramp up will happen starting FY24 itself.
Okay, got it. Thanks. That's all from my side.
Thank you. The next question is from the line of Nidhi Babria from Envision Capital. Please go ahead.
Thank you, sir, for taking my question. So I just want to understand the near-term growth drivers. If EVs and other divisions are going to contribute to the overall growth, will our consolidated margins dilute for a couple of quarters or so?
You want to know about the growth drivers?
Yeah.
Largely the growth driver is the industry itself. And as we know, being auto component player, we grow not only in line with the industry, but our growth is about 2 to 3% generally over the many years over the last decades, 2 decades. We outperform the industry. So in general, I think market the industry has been growing at about 15%. So Sundram Fasteners will definitely grow the domestic segment at least by 20%. That includes both our aftermarket and the OE business. And the export business has been flat this year in dollar terms. We have benefited from rupee depreciation. But going forward, based on indications from the customer, we expect current year FY24 to be a good year for our export market.
Okay. And so by when do you expect that we would need the further expansion, especially on the industrial side, as that is going to give us the highest growth?
Can you repeat the question, please? Not clear. Expansion?
Capacity expansion. By when do you think we would be going for the expansion? Is because our industrials are expected to grow at 20%.
Yeah, that's as part of our medium-term plan. Like the previous cycle, where between FY18 to 20, we had invested close to about 1,000 crores. On similar lines, we are working out or meeting the industry expectation by way of incurring additional capexes, which we had mentioned earlier in the call.
Okay. So any understanding on medium-term EBITDA margins, will it get diluted once EV and new segments will start to contribute, even the defense, aerospace, and those segments?
No, I think like I said, the EBITDA is around somewhere between 15 to 16%, even in the 9-month period, and it should only improve from here. I don't see it going down. Like I said, once the recovery from customers happens fully, all built into our Q4 results, we expect only uptick. But significant movement back to 17-18% will happen only if raw material prices soften. But we expect with our new businesses, export businesses, with more focus on EV, etc., should offset some of these impact on margins.
Okay. Okay, sir. Thank you.
Thank you.
Thank you. The next question is the last question from the line of Jay Shah from Capital PMS. Please go ahead.
Hello. Congratulations, sir, on this set of numbers. Sir, could you please throw some light on, the opportunities that are arising out of the whole, railway capex that you mentioned in the starting commentary, or even, let's say, on the whole EV front? What are the kind of opportunities and, you can say the systems that we are looking to get into, like what kind of spare parts or what kind of, machinery equipment would you be focusing on when to get into the whole EV sub-segment and even for the railway segment?
See, I think while we have mentioned that the India budget called for huge outlay on capex, that would propel multiple industries, including the auto component, where we are present in a large way as on date. So that would propel activity in the area of M&HCV, your passenger car segment, with so much of disposable income in the hands of individuals. So people who are in the two-wheeler segment are expected to move up the chain. So that would propel your car procurement. And similarly, the pandemic, which has push the last mile connectivity by way of e-commerce. That is the order of the day, and we see a lot of traction in the LCV segment also. And with the good rain and monsoon, the tractor segment is doing well, and it is expected to do well. So these are all the broad growth drivers which we are seeing emanating out of the India budget.
Also, the government spend on highways. There'll be a lot of road widening and building new roads, so which will again require movement of material resources. So the truck demand should get further momentum.
Okay, sir. So just taking this question further, so would it be more of our legacy business of the partner itself getting a good traction, or there will be new parts? As in, can you throw some light on what we are doing on the innovation and R&D front? Are we, coming up with some other products for the railways or fast cars or even MXCV, or we are still continuing majorly with our legacy products? This is what I wanted to know.
Largely legacy products, but having said that, the new product also accounts for 30% of our revenues. And unlike other sectors or industries, we don't here design products. So we only design products and we only develop products. So the customer gives the design or the print, and we develop parts according to that plan. So I was more referring to our existing business.
Okay, sir. Thank you so much, and all the best for the future quarters, sir.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to Mr. Dilip Kumar for closing comments. Thank you, and over to you, sir.
Yeah, so I thank all the investors for a patient hearing, and I was delighted last 1 hour to field a variety of questions. Hope we have clarified our performance, expand our performance, and the outlook for Q4 and how FY24 will pan out, and the recovery in the export market. Overall, I think it has been a satisfactory performance from our perspective. Thank you.
Thank you very much. Ladies and gentlemen, on behalf of Avendus Spark, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.